Greetings, Dr. Jeffrey Scott. This is my weekend market update for February 5th, 2023. My email address is hgsidoc@gmail.com. If you're new to the channel, please hit the subscribe button and the alarm, and that way you'll get notification when I place these. I typically do them each weekend. And occasionally, if there's big changes in the market, I might do something during the week. I titled this was Friday a shot across the bow for the bulls or just a head fake. I'm a war buff, and a shot across the bow would be if you want somebody to stop, change direction, and it's a concerning thing if you're sitting on the boat where the shot came across. And so the question was Friday a shot across the bow for the bulls, and meaning the market's going to come back from here, or was it just a head fake related to a one data point from employment? Time will tell. I'll show you the arguments for and against. Disclaimer, this is for education purposes only. Anything I talk about, recommend, is in the spirit of education, should not be considered investment advice. I am a doctor, not a broker. I am independent. I have paid for the tools that I use, and trading involves risk, and you are solely responsible for any investment decisions you make. If you like these videos, especially if you want a shorter version, Monday through Friday, I will post something at stocksanddocs.com. Regardless if I record it the night before, early in the morning, it's placed by administrative team, and they place it usually at 8:30 in the morning Eastern before the markets open. I like to always start and look at how the markets performed. I put the major market indices in yellow, and there's some interesting things here. The Dow, which had been the big leader, actually was the laggard in the major indices this week, kind of flat, down 0.2%. Look at what the Russell did, up 3.9 despite a minus 0.7 on Friday. And look at, despite large down days on Friday, the Qs and the NASDAQ. FANG stocks, again, large down day on Friday, but up 7%. And ARK Innovation, despite being down 3.5 on Friday, was up 6.10. So there was a lot of positivity, especially in small cap and technology. Now, maybe we should be cheering that we're in a new bull market here and not talking about the bear. And why would I say that? If you look at off of the lows, how far have we moved? And you could see, led by the Russell at 21.2, the Qs at 20.4, the major indices are 18.3% or higher off the lows, approaching bull market territory. Just to tamper down the enthusiasm a bit, you can get massive rallies, even as high as 25 or 28% in a bear market rally. So we still are in a bear market, and this is still a bear market rally as far as I am concerned. However, I could be wrong, and time will tell. Here's a little bit about what the sectors performed. Market was led this week, continued by communication, technology, and discretionary. I'll show you some things on Friday that made me feel that perhaps there's some more rotation coming. Now, I'm going to show you when I get into wealth charts some concern that maybe the rates are bottoming, and they're at kind of a pivotal area. Because if the rates go higher, and I'll also show you a similar picture in the dollar, if the rates in the dollar go higher, the markets are going lower. So on the left is the 10-year. You can see it actually was up a bit this week, kind of flat here on the 30. To be honest, neither of them had much change. But I'm going to show you when you draw some trend lines in and look at moving averages, they may be at a point of support. Is there a recession in our future? Well, I think when you look at credit risk, tightness of credit, when you look at the yield curve inversion, both of these are things that have been associated with recessions and bear markets. So a recession, a bear in a recession is a whole different animal than a bear in a secular bull market. Breadth is extended. Stocks above the 200 on the left, stocks above the 40 on the left below are at levels we haven't seen perhaps since 2021. They are extended. Now, we came off such a bottom and so oversold that perhaps this isn't going to matter, and perhaps we just keep going higher to the moon. But I think we've got to be careful. Now, I always like to talk about the T2121, which is a 13-week new high, new low. Whenever it hits this line, the market pulls back some, and this is um, the spiders, and you could see just a little nubbing pullback, and it kept going higher. I am still worried because we're still in that overbought zone. Now, the buckets also gave me a clue, and in my newsletter to some of my friends and family on Thursday night, I actually commented on how I'd taken some profits. And you might ask why. Well, I look at the buckets intraday and Q, and even though on Friday only about 17% of stocks were above the Bollinger Band, you got over 20% right at the top. You are certainly overbought by this picture. Look at where we were on one day earlier on Thursday, where we approached 40% of the stocks were above their Bollinger Bands. Now think about that. If you take the S&P 1500, which means somewhere between 90 and 95% of the time, a stock is going to stay within their Bollinger Bands. And if 40% of the market is so extended that they're above their Bollinger Bands, what do you think those stocks are going to do? They're going to come back in. And that really told me to expect a pullback. Now we're still extended but more neutral. The other thing is I took that T2121 deer down to a daily, and we just were flatline Wednesday and Thursday, and then you could see Friday we actually came down with the market. So are we done and can we stabilize here? Maybe, but I still think that we're overbought to the point where I think there's danger here. Now, danger could be sideways move and more rotation. It doesn't have to be a major pullback. The Hindenburg Omen, I don't expect this to fire anytime soon, but it gives me percent 52-week new highs and lows. And notice throughout the 2022, and I could go back to day one, the NASDAQ had lots of new lows. You have to be more than 2% to be red. And we haven't seen any new lows really this year. And we've started to see increasing new highs on both the NASDAQ and on the NYSE. That's bullish. Now, I saw some things about crappy stocks going up, and that's what's going up. I saw it on the Northern California growth investors. I'm going to call them bulletin boards anymore. But I guess the E-list, I don't even know what you would call it. But what it did here is every week I take a snapshot of the fundamentals of the market. And then I can ask a question of what is driving the market's behavior. And ERG is combining EPS rank, relative strength rank, and group rank and giving you a number. And in a strong bull market led by growth stocks, you'll see a lower left to upper right curve where the better quality stocks outperform. Well, we're seeing the opposite here. We're seeing lower quality stocks outperform, and I call that a junk off the bottom rally. In fact, imagine this. Stocks with high relative strength were flat on the week, and stocks with horrible relative strength, the worst decile, were up over 10%. So low relative strength stocks are leading, and this to me looks like rotation into the worst stocks of 2022. Why else is ARKK up like it is this year? Know your news and earnings. After last week's massive news week, this is a light week. We got some Fed inflation expectations, the usual Thursday jobless claims, and some University of Michigan, my alma mater's consumer sentiment on Friday. But, not anything like last week. I think there is a Fed speech on Tuesday or Wednesday by Powell. Earnings are another massive week of earnings. I thought earnings, except on Friday, Thursday night earnings going into Friday, I thought stocks were treated fairly well, even when they missed. But Friday we saw a reversal of that trend, and there were a lot of stocks punished on Friday after softness on Thursday evening. Remember my statement, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So markets followed through on the prior Friday's late day weakness. You can see my video last week to see what I'm talking about. Opened soft on the week, rallied through the Fed announcement and statement, and then eased into the end on Friday after super strong employment numbers spooked those expecting a Fed pivot. The markets ended the week mostly higher, led by the NASDAQ and small stocks. I showed you the Dow was negative. We're seeing a junk off the bottom rally, biggest losers leading. Breadth peaked by several of my tools on Thursday, so the Friday sell-off was, to me, was driven by technical factors of being so overbought. The question is, are we done with that sell-off? Don't know. I think the more concerns people have about the employment number and the unlikelihood of a Fed pivot is the more likely that we sell off to continue the beginning of the week. So what happens now? Look at the NASDAQ and Russell 2000. That's performance in about 5 weeks. Not sustainable. I don't think we can ignore the overbought nature, but it doesn't mean we have to have a collapse here. I don't feel like we're going back to test the October lows. We might be able to going back to test the breakout points, and maybe a pause to refresh here would be the healthiest thing we could see in this markets. So I took profits on Thursday. Why? Because the buckets told me the market was at a level of reversal. Compared to my thoughts over the last several weeks, the risk appears to be more balanced. More balanced means there's more risk to the downside than there were the last couple of weeks. My weekly timing model is still buy for each of the major indices, but my conviction to the long side is wavering in the setting of some extreme levels of overbought. That means I took some profits on Thursday to raise cash. I am still have a number of long positions. I may exit those very quickly if the market sell-off continues this week. So let's go on to the charts. We're going to stick with wealth charts today, and I'm going to show you in the next 20 minutes or so how I look through and get a sense of what's working and what things I might want to look at this week. We'll start with the wealth scanner looking at the hot stocks, but I'm looking at my top-down indices to get a sense of what parts of the market are moving. The flame means a pretty rapid move. So short treasuries, not necessarily a great thing if you're bullish in the market. And then SARK, short the ARKK, and natural gas, which is beaten down, both had some flames. But you'll notice that the wealth score are either less than 0 or very low. So I'm not going to worry too much about looking at those. Could be a sense of rotation, though, in a weaker market. Now the indices, let's just spend some time on the spider because I think the spider will tell all the story that we need. So the market opened here, and based upon the data that we saw on earnings and the employment number, the market dropped significantly at the open, but actually traded up and was positive for a short period of time before selling off into the close and really finishing at the low of the first bar. Kind of interesting, or within the first bar. Now, if we look at the daily charts across these indices, we're going to see a very similar pattern. Each of them have broken out of the descending trend line that has been with us since the beginning of the year, January 4th of 2022. Still bullish, do not like this candle here, and it's a bearish candle, and would it surprise you to see us come down and probably not get down to this trend line, but will we start to track up this trend line here, which we've ran up before? Now, in my opinion, for what it's worth, it might be painful for a week or two, but boy, would that be bullish in the long run if that holds and we go higher. I just see something extended where it looks like with this bearish candle we could see a couple days of weakness. Here's the Qs, the exact same picture. The Dow isn't really doing much. It's kind of going sideways. It's the only one of the major indices whose daily bongo turned red. The rest of them are daily and weekly green. The IWM, similar pattern, broke out. They all broke out of these trend lines, which is why I was so bullish the last couple weeks, but also a bearish candle. Not seeing much here at the VXX. Yeah, you'd expect to see something. I'm just curious if what Tastyworks has the VIX here. And you could see even with the VIX on Tastyworks that we're not seeing much of a move on the VIX. And then probably the most concerning on this page is the dollar, because look at what it did on Friday. The dollar, which has been remarkably flat, but flat with a small descent, had a reversal on Friday, was up 1.31%. You got to watch this line, because this line to me is going to be the story of what happens. It was resistance in May. It was resistance in June. It was 1 day resistance in July, and then a big gap above it, and then we came back in August and we retested. Okay. What did we see on Friday? We saw a big move up, and if we break above this line, I think the market's in trouble. I'm going to be watching that closely. Commodities, strong dollar, gold really sold off hard, as did silver, oil, which has been more sideways than gold, and then natural gas, which is just dead. I talked about what happens if we're done going down on the 10-year. This is a 200-day moving average, and you could see a reversal off of that. Got to get above the 50, but the 10-year interest rate could be giving us a clue here about the Fed raising more rates, and that will not be good for the economy. If the 10 goes up and the dollar goes up, the stock market's going to drop. If I look at the weekly market timing signals very quickly, as I might expect, they are doing well. Price close well above the 30-week WMA. The weekly bongos are green. We actually have a long way to drop before we trigger sell signals. So this is still buy, but my conviction is the issue here, and we've got to prove to me that we can break out above the Friday highs before I get that excited. Market theme, the way up we saw in 2021, we saw large cap growth lead. In 2022, we still saw strength in the large caps. If we look over the last few days, we've rolled over, and when we point this way, it shows small caps are in charge. So a rotation out of large caps into small caps might be going on. If we look at growth, which will go up here, versus value down here, if we look at the daily charts, we can clearly see that we have had value in charge. Large cap values defensive. But when I look at that hour chart, I see, hey, we are come off the bottoms and we're seeing a little bit more interest in growth. A switch to small cap growth would certainly favor things like ARKK, and that might be part of what's going on here. Next thing I like to look at are my S&P sectors on an hourly, and the things that have stars on it and the money bags were the last couple of weeks were the leaders. And you notice that communications, technology, and discretionary all got to good levels, but they've all eased off of those. May or may not be significant, but then look at financials, staples, real estate, utilities, and healthcare. They're all showing a little bit of strength the last couple of days. We could have another round of rotation coming here. Again, we could go sideways in this market and have massive pain because of rotation, but overall the chance, a pause to refresh is not a bad thing. So going into this week, I might have interest in some bullish and some bearish positions. I've got my CAT scan set up on the bullish side to look at 5 and 500,000, at least one bullish dot, a reversal in the last 2 weeks, and bullish signals on the bongo, and the opposite I'll show you on the bear scanner. Let's first go to the wealth scanner and take a look at what are the leading industry groups, ETFs, etc. And what we can see is retail is super strong. Last week we looked at American Eagle. The FANGs have been super strong. ARKW, XSD, semiconductors, communications, and the Russell and cloud. I got to tell you, if I'm thinking bull market, this is kind of exactly what I want to see lead, isn't it? Technology, the FANG stocks, retail. Wow, the Qs. Now, that's actually good, but this also reflects the market that we've been living in. Doesn't necessarily tell me where we're going. And if you look at the relative strength leadership, this is what you see. Now, if I go into CAT Scanner, let's look at individual stocks. Let's rank them by the dots and see what comes up to the top. So I can tell you right here, there are some good looking stocks that I'm interested in. And the reason why I run my scan is because I want to find stocks here that are in a long term, let's pull up Clorox, in a longer term uptrend with the weekly bond go green. I would put this one in the choppy, but going up. In the short term, I had to have within the last 2 weeks that the red daily bongo signal showing me that it pulled back on the daily. I'm looking for my dots. I'm looking at the squeeze. I'm looking at relative strength in OBV. And I'm not sure I'm chasing Clorox, but if we are rotating to consumer staples, something like Clorox, which pays a dividend, might be interesting. I don't like this reversal stuff in 4 days. It's had 3 days with 3 dots. You can see why it had the red dots here. But you have volume, breakout momentum, massive improvement in relative strength in OBV. I don't like chasing, and I would feel like I was chasing this one, but I have to point out Clorox is one of the highest ranked stocks. CBOE, another one that I find perplexing. Look at this candle. It's a belt hold. They must have had bad earnings, and then they reversed and closed higher on the day, up to 2.85%. Again, volume, breakout momentum, out of a squeeze. Not happy with the relative strength, but one I might be looking at. Kemper, this is, I believe, in insurance. So in the financial group, this one looks different. Why does this one look different? Well, it's not in a squeeze, which is bad or good, depending on your opinion. The weekly bongo has been steady green with relative strength is strong, and it broke out above a lot of chop, and you can almost see a cup and a handle breakout here. Lots of volume, breakout on volume with momentum with relative strength support. Kemper looks interesting to me, and when I did my workout today, or my marketplace education, I highlighted as Kemper and how I might trade that. Aniline also looks interesting here. This is a biotech that gapped up on some really good news back here in August and really looks like it's getting ready to run again. And so pull back to support here, and then over the last couple of days it's had volume breakouts, momentum in a squeeze. I'd like to see relative strength peek its head up, but I like that pattern quite a bit. Interactive brokers is another one that's breaking out here. And all of these will have that pattern of weekly bongo, a pullback on the daily, and breaking out. So interactive broker. Let's see if any of these were the ones that I really liked. ANF, we talked about retail stocks leading. So this one would have been a better time to buy back here when the relative strength went up and we had a bunch of green dots. But it's given you another opportunity here as this continues its run. Now, since retail was the best one on the wealth scanner, I could actually look at just retail. And I think you're going to see, yeah, this guy, which I don't really like pawn shops, and I don't like a red candle, but this was a gap up. So I don't like EZPW. I just showed you ANF, which I do like. And the one I looked at last week during the week was American Eagle Outfitters. And I like this one a lot still. And maybe it's going to give us another buying opportunity by pulling back into the moving averages and breaking out. Gap is another one that looks interesting. GPS. And, is it too far gone? I don't think so. This is a stock that was much, much higher before the market sold off. And with retail moving, do you really think Old Navy and Gap are going anywhere? So you've got green dots breaking out of a area of congestion of the moving averages. Um, you have to go all the way back to February to get to higher price stocks, which means everybody who bought since that date in February are up at this time. Relative strength looks great. I like retail. I like Gap. And probably the one I like the best, but may not be at a good buy point, is Capri Holdings. Nice run up there. We've talked about that. On the bearish side, I run a very similar scan. I have a higher price, same volume, like to have options. Bearish dots, no bullish dots, looking for a reversal in a more shorter period of time than 5 days, and make sure I got the bongos as bearish. These are what come to the top. Let's rank them by dots. And we could see some things that might look interesting from a shorting perspective. Now, I'd rather, often I'll buy contra ETFs or I'll buy puts if I want to short. I don't short when I'm sitting right above the 200. You could see it bounce there, it bounced there. That was Ashland Oil, Avery Dennison. This one looks like it wants to go lower, but it's right above the 200. This is what I actually own that I got to think about offing if it doesn't rebound on Monday. This is Axosome. It's had a beautiful run off the 35-ish range. It's a drug company. They had some less than predicted sales come out on a weekly or monthly prescription tracker, which is notoriously inaccurate, and the stock broke down. Yes, it's above the 200, but it's got 20 points down to the 50 to drop. That looks like an optimal short. Breakdown of relative strength in OBV. I would probably not short it unless it breaks down below the low of the bar, but Axosome looks like one that's going lower. Bill.com, really after a big gap up broke down. If it gets below this current level, it's getting into an area where there's a lot of air underneath without any clear-cut support. Look at relative strength at OBV. A lot of these look interesting from a short perspective. Humana, one of the big payers, big Medicare Advantage insurance company. I hate shorting these things because they have done so well for so long. But there was some information that came out this past week that's going to impact their star performance, but also things that are likely to impact on their risk scoring, which means they're going to have to pay money back to Medicare. This one is one that to me is also an optimal looking short. There is nothing anywhere close below this. The low on this bar is 20 bucks away. I would take a 20-buck move. Lots of red dots, volume, breakdown, momentum to the downside, relative strength at OBV. Now think about what we just did in 17 minutes or so. We looked at the state of the market, identified some opportunities of market rotation, looked at the leading industry groups, and then using the CAT scanner identified 3 stocks to the long side, 3 stocks to the short side. I can close up my computer and go to sleep now. And if the way I had this created was because I work full time, and this allows me to very quickly look at the markets, identify a couple of things to play, others for a watch list, put in some conditional orders, and be done in much less than an hour. Now, just to spend a few seconds on my watch lists. People like to see them. A watch list just means I see something that intrigues me. It does not mean I am going to be long or short. Okay? It means I see something that intrigues me. So to the short side, as an example, I looked at Humana already. This is United Healthcare. It's already broken down and dropped more. And I believe its earnings are out. Cigna is another insurer. I would not be shorting this one unless it breaks down below the 200, and I would like it more if it trades back into the 200 and breaks down. Amazon held up pretty well after its earnings miss. Um, so I put this here to watch, but it failed the 200. It's going to come down and retest the 50 and the ISO failure philosophy of David Elliott. So I'm going to see if that holds. I looked at Axisome already. Electronic Arts screwed the pooch, and so it's making all these gaming stocks, whether it's Activision, look weak, or Take-Two Interactive. And then, interestingly, some utilities looked weak. AEE breaking down here. So this was a list of stocks that I am going to monitor as potential shorts. Will I short any of them? I don't know. It's Saturday night. But what I will do is watch them. And if they all turn green on Monday morning, I know that the market is probably not going down and that these things will not be something I'm going to chase and short. All right. On the other hand, if they open red across the board, I might take a few of them, and more importantly, I'm going to start emptying out my long positions. Speaking of long positions, I have a number of stocks that I'll be watching on the buy side that are listed here. There are a lot of them. Let me show you some of my favorites. ASC, Ardmore Shipping, is one that we've made money on already this year on this run up. It was one of our favorites. And what happens every time it pulls back, pulls back, pulls back, it runs again. So it's pulled back on the weekly, and on the daily, it's coming out of a squeeze with lots of green dots and strong relative strength at OBV. I like ASC. That might be one of the early ones I'll be looking at. ATI is my favorite on the steels. It's a differentiated steel product. Now the problem with ATI and the steels, let me just look at, here's US Steel for example, which is also in a nice pattern. But look at the earnings per share growth has fallen. It's a value play with a PE of 3, and if you look at historically, the PE ranges from 1 to 207, so it can't get much lower. But let's look at ATI. Notice the earnings. The earnings are going up. All right, so that's very different. On the daily chart, yes, it's broken out. It's run a lot. I'd rather buy it when it pulls back. You can see its relative strength is high. This one looks very interesting to me. It's certainly not overpriced. So ATI looks good. I'd rather buy it on a pullback. Bristol Myers Squibb is pulled back right now, but it looks interesting here. And I want to point out one of my favorite signals that's getting me interested. Notice it's got the first dot, 2 of them in a row. That's my momentum. When I see multiple momentum bars in a row, it's typically got a big move coming. So I'd like to see Bristol Myers Squibb get above the 50 and 200. It looks like that happens early in the week, and Bristol Myers Squibb looks interesting. A lot of good looking stocks. Flextronics, which I thought was a contract manufacturer, nice uptrend, and I'm buying it on the pullbacks. Pullback and a run. Some of these we've already seen. Here's that Kemper, Meta, and then this is another one that's interesting. So when I first saw this, and actually I talked about it on my program earlier today for the marketplace owners, and I said, do your research, make sure this isn't up on a takeout. It's up because it has a drug that can eliminate amyloid deposits. Amyloid is the thing that is felt to be related to Alzheimer's disease. So it's a very early phase study in a disease state that's quite emotional with positive results. I think this is probably a takeout candidate. Let's just look at PRTA with my MarketSmith data and see what the market cap is. But this is up on a data story. You could see it will not make money forever. Right now it's kind of in a Darvis box. And you could certainly argue not to touch it until it takes out these 66 numbers and starts showing a clear move up. Market cap is almost 3 billion. That tells how good the data was. I think this one looks interesting, but it's a high risk. And then I'll stop with SMCI, which is probably one of the ones that I'm more likely to trade early in the week. This has been a monster stock. Look at this going back to March. This is in 2022 where it's ran from 34 to 95. It just had a pretty significant pullback, and I drew this trend line weeks ago because every time we got there it got a sell signal and it pulled back. We've now broken above that trend line, relative strength at OBV, and this one looks interesting as well. So 36 minutes, not bad considering how much I showed you. Have an awesome, awesome week, and we'll see you hopefully at the Wealth Charts intensives where I'll be speaking from 1 to 4, I believe, on Friday for Wealth Charts owners. Take care. Have a great night.